Hello and welcome to this Deccan Herald panel discussion on personal tax. I'm Anupam Manur, an economist at the Takshashila Institution, and I have two fantastic panelists alongside me. I have Ravi Jain, who's a partner, PwC, partner of personal tax, PwC India, and Saraswathi Kasturirangan, who's a partner, personal tax of Deloitte India. While part A of the budget speech was largely deemed to be disappointing and even perhaps boring, part B is generally the part which gets a lot of attention from viewers because it affects them directly in terms of taxes. So let's get a first kind of reactions from our panelists regarding how what are the big changes or what are the real big surprises in the personal tax section. Ravi, if you could start with you.
Sure. So on the personal tax section, it was very interestingly carved out. So in one hand, like a lot of tax rationalization measures came, but it was brought in like a new tax regime, personal tax regime, and an option was given that either you can take this or there is no changes, you continue with the old regime. Right. So this was a smart way of moving it. If you look into the fine prints, they say that almost 70 exemptions which in the old regime is available is not available if you adopt the new rationalized tax structure. Right. So one will have to really weigh as to which one is more beneficial. So that was a really smart way of giving it and not giving it as well. So that is my initial reaction on this.
The finance minister actually introduced this as a highly simplified tax regime, and that it would make everyone's life easier. Is it really that simplified? What I'm really interested in, will I need a CA to file my taxes next year?
So with the increased number of tax rates now moving up from 3 to 6, it looks exciting and maybe a little attractive. But as you rightly said, is it really simplified? So there are a lot of conditions, as Ravi said, that if I need to move over to the new tax regime, which is obviously looking more attractive because the 30% kicks in only at a 15 lakh level. Till that time, I don't get into the maximum rate. So is it really attractive? So we've just did a back of the envelope kind of calculation after looking at the fine print. And what I do see, say if you look at it, a salaried employee, say somebody is earning an 8 lakh kind of income, they would obviously have various allowances and deductions. Say for HRA, they would have something for LTA, they would get up to a 1.5 lakh deduction. All of this they would be availing today, and they would end up not paying any tax at all. Right. But in the new tax regime, if I opt for that in this kind of a scenario, I would end up paying taxes. Right. So it's a surprise in the fine print. So obviously, if you look at it straight away and on hearing the speech, even I felt the same, that for somebody at 15 lakh, I would possibly get a 30,000 saving in tax, even if I consider the 1.5 deduction as not being availed now. But that's not there. When we actually do the math, I don't think this is really going to benefit the salaried class. Maybe the non-salaried class who are not having these kind of deductions, they may find it a little attractive, provided they don't even take that 1.5 lakh deduction. So I think they are going to need some amount of help to see whether they would really be benefited by the scheme.
Sure. I'm just thinking through this, would I then have to calculate my tax rates under both regimes and then choose which one is lower? Which means it's actually a lot of work in that sense?
So, 2 point of view, so we do not know whether that option is year on year. So, do I do it every year and opt for it? Or, say, suppose in this year, if I opt to move into the personal tax regime, the new regime, then I am there forever. Right. So that one has to examine. That's one. I suppose that is one. And second, another interesting point of view is that if you go into the old tax regime, up to 9.5 lakhs, you were not paying tax if you were using your standard deduction, your housing loan interest, and suppose you have those ATC benefits, right? Also, if you look at the income level up to 9.5 lakhs, actually people do invest that much. Do we have that disposable income to invest? So for that category, maybe new tax regime could be really useful, because without investing anything, then you are moving into a lower tax regime, because in the old tax regime, you are not paying tax at the cost of investment. But then the contrary point is that was actually forcing households to create savings. So then do we kind of move out of the culture of savings? As it is, savings are reducing. So that's an another contrary viewpoint to this whole debate.
Yeah, I totally agree. See, as I said, typically anybody who's in a salaried class would have some kind of a saving because PF definitely would be there. So I would like to take the benefit under Section 80C, right? And life insurance. These are minimal things which any household should be encouraged to do. So from that perspective, moving away to a no deduction, a flat rate seems to be a little disincentivizing investments and savings.
Yeah. Just to give some context, the overall investment rate in the economy, that is the gross fixed capital formation, has fallen from about 39% to about 29% in over a decade. Household savings rate has actually been falling. Now, household sector financial savings is just about 6.5% of GDP. In that context, if we put this in that context, now, while the new regime might in some ways boost consumption, it might actually disincentivize savings and investment, as you've said.
Yeah.
So just to add, but if it's a short-run thing, Anupam, then maybe it's good because, and also Finance Minister mentioned that by 2025 we will have the maximum working class population in India. And also if you look at the millennials, the trend is that they don't like to invest for future. They want to consume what they earn today, right? Yeah. So going by them, then this move can be really beneficial. And in the short run, once the economy actually takes off and then we move back to the old scheme of things, it might work. So you never know, which direction we are headed, whether it's kind of a move towards because simplification has been another agenda of this government. Yeah. So whether this is a stepping stone towards simplification, whether in the DTC we will see that, this is going to be the order that no deduction, no exemptions and lower rates.
Yeah, so I would think, is this what we're going to see in the future? Yeah. That is this a hint from the government that be ready for this kind of a regime? Yeah. You're not going to be seeing any deductions and exemptions in the future. Because today, to me, this scheme does not make sense. Because if you go through the fine print, leave encashments, house deductions for house property, all of this are taken away under that regime.
Right.
I wouldn't really like to give up those kind of deductions.
Yeah. So this could be a transitory step in terms of, we don't know, but it could be a transitory step where, probably 2 years hence you will not even be given that choice and they might just go with one regime, which is now the no deduction regime, which might not be as good news for a lot of people.
Absolutely.
Yeah, but at least it will be simpler for the, and it might increase the compliance rate. It will reduce the cost of administration from the department perspective because as many exemptions, the tax officer has to delve into the file to clear or refunds and all that. So if you consider on a holistic basis, you never know that this might be working because I was just going through the list of exemptions which have been taken away. I think except for employer contribution to NPS, everything else is almost removed in the new tax regime if you have to avail these lower rates. Yeah.
So just on that context, there were 100 exemptions before, of which now 70 of them have been removed. So that's considerable progress in that regard.
Yeah. But let's, not forget that it's optional. Right, so one can actually opt or can remain in the old one. Yeah.
So before we move on to other big happenings like the DDT and ESOPs, are there any other really big takeaways for you that you want to highlight to our viewers?
Well, I would say that one surprise I saw was that there is going to be a ceiling introduced in respect of contributions which are exempt today. So, for instance, if an employer makes a contribution to PF, it's totally exempt without any ceiling. For superannuation contribution, there's a separate ceiling of 1.5 lakhs and so on. For NPS also, there is a ceiling of 10% of pay, but it's only a percentage ceiling. It's not a number ceiling. But today, the government has sort of introduced a 7.5 lakh ceiling. So the intent is, of course, that individuals at higher income levels who seem to be making a ride on this because they do get a tax exemption irrespective of a ceiling. The idea seemed to put a clamp on that.
Right.
So to my, again, back on the envelope calculations, individuals above 50 lakhs of income are of basic salary would be impacted by this, and they would possibly need to relook at their tax numbers for next year because I'm sure they are not the category who are going to be availing the simpler tax regime. They would need all these exemptions.
Sure, yeah.
So to me, Anupam, on that question, although hidden in the fine print, but slightly a good news was the tweaking done in the residency rules.
Right.
So this was interesting. There are two important things there. So let me take the simpler one first. Was the citizenship-based taxation, which was not there in India. India never followed a citizenship-based taxation, unlike US. So what we have said that if any Indian citizen is not liable to tax anywhere outside if the person is settled or working abroad, then merely because he is an Indian citizen, the person will be subject to global income taxation in India.
Right.
So this is a major change. That's one. And second was for the incoming expatriates, basically. Let me bring in expatriates because we are all trying to attract investment. So the positive move was that to become an ordinary resident in India, there were several conditions. So they are again simplified, and the number of years you take to graduate to an ordinary resident and therefore become subject to global income taxation has been delayed to now 4 years. So you can actually become only in the 5th year. So what they did was that there was a 2-year stay criteria, 730 days in last 7 years. That has been removed. And only if in last 10 years, 2 years you qualified as resident, then you were graduating to to become an ordinary resident. Right. That has been made 4 years. Okay. So which means all these foreign companies who are investing in India, sending their senior personnel, foreign citizens to come and work in India, will actually become subject to worldwide income taxes in India only in the 5th year. So which is a welcome move. So means we can attract more talent into India, more investment, without senior guys being worried about subject to global income taxation. So which is a good news, I think.
Oh, actually, there's one more perspective to it is that typically persons of Indian origin who are employed overseas, they could come to India and not trigger a residency even if they were present in India up to 182 days. Now that has been brought down to 120 days. So this means that somebody who is today enjoying a status of non-resident because I'm employed overseas and I keep coming to India on visits, now I'll have to cut down the number of visits if I want to retain the non-resident status. Right. Because they do feel that this is something which is enabling people who do have business presence in India to keep a non-resident status by reducing the days of presence in India. Right. So that's another angle.
So on that point, Kasturi, so connecting this point and the citizenship point, so a lot of wealthy Indian citizens, staying away from India, trying to not pay tax, and like as you mentioned, planning their residency. This can be something which can bring them in the tax net.
Right. In it. This is to do with the market's fall and the reaction of the market and overall kind of rating of the budget. How would you rate this budget? Was it does it actually reflect the kind of reaction that we're seeing from the markets, with Nifty falling above 300 points? I think Sensex fell more than 950 points. I might not be very current with the numbers, but we've seen massive dips. So would you say, there's one which is the investor sentiment and from a larger, from in terms of macroeconomics, but also there's also individuals who might have reacted to this. So do you think that it's proportionate?
Yeah, so I think one, it could be that it's more that there's a lack of expected view in the budget. So I would be expecting something and I don't see that, so there could be a disappointment. The other thing also may be to do with the dividend distribution tax being taken away and the dividend now being taxed in the hands of individuals. Right. So earlier you had a 10 lakh kind of an exemption which was there for dividends to be taxed in the hands of individuals. So now with the dividend distribution tax going away, that would not be there. And earlier that whatever was taxable was at a flat rate of 10%. Now, as I go on higher on my income levels, these dividends would be taxed at my normal tax rate. Nice. So that could be one sentiment. But I think overall, I don't see there is anything that is there for us to worry. You may not really have got more than what you would have expected. I feel we are status quo.
Yeah, I think it's not really in terms of the harm that it's doing, but it's just not in tune with the expectations.
Absolutely, that's my view.
2 points. I think one was, of course, the slippage on the fiscal part by 0.5%. And second, as Kasturi was also alluding to, the expectation market was having, I think long-term capital gain tax was a big expectation in terms of either reducing the holding period or maybe increasing the exemption limit of 1 lakh and all of that. So that is something, because STT also is there, right?
Yeah, STT
so that area was totally untouched. So maybe based on their expectation on this count, it could have been discounted.
Yeah,
of course, multiple factors. So, I mean, this could be just one.
Expectations not being met. Probably.
Yeah, there was some expectation on that there would be a reduction in long-term capital gains or at least removal of STT because it amounts to double taxation, if I'm not mistaken. That there is both STT and long-term capital gains, and people are not very happy on that front. But there was no movement on that at all.
Yeah.
I think the STT is more to make sure that the government is able to track the transaction, not that the quantum is too
It's not precisely double taxation, so
Yeah.
because it's on the entire transaction, it's a very, very small amount, and long term is only on the gain, so you can't say it's double.
And gain also there is a threshold
Yeah.
on about 1 lakh. So it's not really double taxation, but it's. I think the STT is more driven by the government's desire to make sure that they're able to track the transactions and it's all in a way accounted.
Okay. All right. Let's move on to something else, that very interesting thing that happened, which is on ESOPs. So they've done this move where basically for the 5 years you will not be taxed, and then this comes in, but it's only applicable to startups if I'm not mistaken. So could you tell us, our viewers, about that?
So an ESOP, I think for startups, this is an interesting move. In fact, this was a demand industry-wide, so not only for startups, but good they heard for startup. So let me just give some background before we, just for the benefit of our viewers. So on ESOP, after you hold it for the entire vesting period, the moment it vests, then there is a notional tax in terms of perquisite on the basis of evaluation linked to the market attached to it, and basis at what price it was given to you, or that differential is taxed as a perquisite at the time of vesting.
Right.
But actually you have not sold the asset, right? So it's a notional gain which is getting taxed. Now, to give comfort there, what the finance minister has done rightly is that the tax incidence has been deferred by 5 years, or when actually the employee sells it, or if the employee moves employment from that company. So any one of these events, whichever happens earlier, becomes the point of taxation. So you don't have to really worry about your perquisite taxation. So this will, what it will do is it will ensure your long-term existence in that company, continue to add value in that company, and from the company perspective also, the real purpose of working as an employee owner continues. So this, I think, will increase more startup culture and should help economy in some ways.
Yeah, I thought there was a catch in the fine print there. If you look at the way they've said, they've put in 3 conditions there. They've said either instead of at the point of allotment of the share, which is what was happening earlier, they've sort of deferred it to either 5 years from the date of allotment or the date of actual sale, or if you leave the company. But then they've said it would be taxed at the rates in force on the year of allotment.
Right.
So say the taxation kicks in 5 year back, do they really expect me to go back and see the 5th year back on which it was allotted?
Right.
Do we really expect the company to do the withholding on that rate? And even the individual to go back and pay at the tax rate? Maybe the government is thinking they'll reduce the tax rate so they don't, over a period of time, they don't want to lose the revenue on account of that. It could be that. But I thought that was a little, not necessarily in the line of the simplification. The other thing which I thought really made sense for startups, because see, most of the other companies which are listed, you can, if you want to settle your tax dues, you can always sell part of it and meet the tax dues. But for startups, typically they are not really listed. The listing will take a little bit of time. So from that perspective, I think this was an ask from the startup fraternity where they really wanted this benefit. So to that extent, I think it's a good move. I just wish they simplify it a little more, at least before they pass it on into the act.
But would it make sense to just make this universal? Why only startups? I mean, I know you said that it's more beneficial to startups, but I'm guessing that every other company would benefit from this as well. Just a quick thought, I mean.
Yes, I would agree. We did have that kind of regime earlier on. India did have a taxation of stock option only at the point of sale.
Right.
But then we moved because globally, I think it's aligned that at the point of allotment, when I really get a benefit, there is a taxation that is there. What is considered is that after it's allotted to me, till that point it is salary. And beyond that, it depends on the period I hold. So if I hold for long term, it becomes a long term capital gain. If I sell immediately, it becomes short term. So that is more or less left to the individual's investment related decision. So it's considered as capital gain. I think the rationale there is fine.
Let's just get to the simplification of the tax rate is one aspect of it, but I think overall in terms of the taxpayers' experience, they've done some aspects there as well in terms of dispute resolution, and then e-appeal and so on. So do you think these things will actually help the overall experience of paying taxes, of if you have any dispute to go and meet with IT individuals as you had to, IT officials that you had to do before, but if it's all simplified, anonymous, or faceless as they say it, do you think that will actually help a lot of individuals?
Yeah, I think in a way, yes. They seem to be introducing the Vivad Se Vishwas scheme, where if I do have a dispute on hand today, then I can go in and do a settlement before 31st of March, and no interest and penalties would be levied. The scheme is actually open up till 30th of June, but beyond 31st, then the interest and penalties may not be fully waived. So that seems to be a good resolution, though I can't imagine somebody going on dispute if they are absolutely certain that it is due to the government.
Right, yeah.
So there would be, I think people would want to take a call saying that what is the probability that it would come in my favor, and if I see that as less, then they may want to go for this dispute resolution settlement. What is also important is that there is a taxpayer charter which CBDT is mandated to adopt. And I think that is done with the sole intent of making sure that taxpayers are not harassed. So we will need to wait and watch as to what exactly goes in there. But at least it gives a sense of direction that the government has heard what the taxpayers are saying, and they seem to be adopting it in various manners. So it's a positive signal to my mind.
Ravi, e-appeal?
Yeah, so 2 points from my side on that, on overall trust building measures with the taxpayers. So one, of course, Kasturi has mentioned trust charter of taxpayers, to making taxpayers know about their rights. I think it's a welcome move. But I mean, at the same breath, I would also say that why we have to do it. I mean, if I'm paying tax, then we know our rights. We don't have to kind of really word it down. But anyways, I mean, if we are doing more, the merrier. The other point on the assessment experience. So of course, like earlier, they made the assessment faceless, right? But first stage, the assessment, you were knowing that who is your officer. So officers also used to call you, and you also go and explain. Then they made it jurisdictionless. So they did a centralized processing of assessment. So you do not know who is the officer. So in true terms, it became faceless. Now they have extended it for appeals as well. So I think that's a welcome move, because the more it is faceless, it becomes more transparent. Another trust building measure, I think, and it was a good move, was to relook at, and in fact, Finance Minister promised that the criminal provisions in the civil laws, like Companies Act, why it is required, right? So they have said that will be removed, and not only in the Companies Act, they will review the other laws also, other economic laws, which directly are all civil acts. Then we do not require those, criminal provisions. So I think that will go a long way to build confidence again from our overseas investing fraternity, because these prosecution provisions are something which they are really afraid of, and a lot of companies they want to kind of be very, very clear on that front. So I think this is another good trust building measure which the government is taking.
Thank you. I think we can pretty much sum it up now. Do you have any final kind of summary statements for our viewers? What is your, if you had to summarize it in one sentence, what would that be of the entire budget? I mean, especially Part B, which is the personal finance.
I would say it's an interesting budget, and I would say we need to spend a lot of time more reading the fine print, basically because what we heard in the speech is not what we are all seeing in the fine print. So to me, the key takeaway is go back home, read the fine print, do the homework, because there's a lot in the detail that is there between the lines.
So I think clearly simplification seems to be the agenda. They want to give it, but they want to stagger it. So I think they were clearly mindful of where we are in terms of the economic numbers as well. But still they kind of wanted to make a move. Some misses, I think, one on long-term capital gain and also on NPS, because they want to portray NPS as the key pension scheme, because PF is something on which interest they are not able to fund. So I think something there would have been great. But overall, I think it's a good, balanced budget from the personal tax side.
Fantastic. Thank you so much. Thank you so much for joining us. And to all our viewers, again, there you have it, folks. It's an interesting budget. but it still requires a bit of homework from our side to iron out all the minor niggles and so on. So yeah, thank you so much and have a great day.
Thank you.